Well, hello again. Thank you for joining us this afternoon for our Ask the Expert session, all about HOA insurance. So the what ifs do happen. Andrew Bateman's going to run us through a couple of slides, and we will ask questions along the way. So if you do have questions, we do hope that you will join us or asking those questions. So I didn't introduce myself, but Ben Rhodes, I am the Senior Vice President for CAMS, and I'm happy to continue to help host these. So we do do a survey at the end, and we're always looking for new content. So if you do have webinars that you'd like to see that we have not done, please let us know. So again, we're always looking for new content. We do record these sessions and we do post them on camsmgt.com. So if you go into the board member resources section, you can see all the many different webinars that we've held over the last 5 years. So with that, we will get started. Andrew, I will turn it over to you.
Well, thank you for the opportunity. I really appreciate the support from CAMS, from Ben and Rudy Sheeler. Really appreciate it. Well, I'm Andrew Bateman. I am an independent commercial insurance agent, but what does make me different is my focus on working only with associations. I do not insure any unit owners, just because it's a time of claim. You need your agent to be battling for the association's interests, and not have a conflict with insuring unit owners also. I'm going to talk a little bit about the insurance industry as a whole. This presentation has wide topics, and it's going to move reasonably quickly, but we are going to leave room at the end for questions. What's happening in North Carolina and South Carolina and in the industry across the country is that we're seeing companies stop insuring condominiums and associations. They're just leaving states and no longer writing that exposure. Two companies like IHG and Condo Pro, they're two that are no longer writing. But what we're seeing in the last 6 months is that insurance companies are making the underwriting requirements so tight and strict that you can't place business with them. So they're not publicly saying that they're no longer writing in this space, but they are making it impossible to place business with them. So they are getting out of it. This industry is seeing catastrophic events with losses that are exceeding $1 billion in the US. So in 2023, there were 28 natural disasters. In 2024, there were 27. In 2027, of course, in South Carolina, North Carolina, Tennessee, and other surrounding states, we had Hurricane Helene. Well, the interesting thing that devastating, don't get me wrong, absolutely devastating. There was $50 billion in damage, but only about 18 billion is covered by insurance. And the reason why is because the peril that was the cause of loss was flood. And majority of the people do not carry flood insurance. And the devastation of the damage was outside of flood zones. So they weren't required. And so there were just massive losses, but it's not going to affect the property rates in North Carolina. What is going to affect us all is starting on January 7th, the California wildfires has turned into being the worst economic disaster in US history. We're going to see those ramifications far into the future, unfortunately, because majority of those damages are going to be covered by insurance. And so there's going to be widespread ramifications across the country. With this presentation, we're covering a lot of topics. The The goals, of course, are to cover, what type of lawsuits happen to your nonprofit corporation. You're running a business that has to have money collected by assessments, and the board has to make difficult decisions that will upset some. So we're going to talk about that. We're going to talk about the important endorsements on property policies, all leading to a very, very important, probably the most important question as a board member you need to be asking. And then every association needs to plan for situations that are not covered by insurance. Well, the what ifs. What are the 3 protections for each board member when it comes to serving on a board? Well, the first is in South Carolina, it's Title 33 is the Nonprofit Act. In North Carolina, it's NC 55. These basically say that your personal assets cannot be attached in a lawsuit as long as you, A, follow your fiduciary duty, and B, you don't get paid or receive any extra benefits for serving on a board. I would even include that if you've got a landscaper that is mowing the front entrance, and as a board president, they're mowing your yard also. Well, that's a benefit that could get you in trouble. So the first is always the Nonprofit Act in the state that you live. The second will be the bylaws. In your association, it states that the association will hold you harmless. If it didn't have that, you would be running for the hills and nobody would serve on their board. Well, the third protection is the indemnification. This is where the insurance comes into play. This is what pays for the defense. And so why are all 3 of these needed? Well, this is why. These are the types of lawsuits against the board of directors. Every board of directors should have a standalone policy. This is what pays for the defense of these lawsuits that come in. The number one question I get asked, because I attend board meetings literally every day, I get asked, what happens if I get named individually in a lawsuit? And how is my insurance going to respond? Well, it's never fun because sometimes the sheriff comes and knocks on your door and serves you papers. I am old enough that I've had that happen a few times in my life. It's never fun when that happens. Other times it's delivered to the management company. Other times it's delivered to the registered agent that is listed on the Secretary of State. Everyone should check their Secretary of State listing for their association just to make sure all the T's are crossed and the I's are dotted to make sure that your registered agent is correct. So when this lawsuit comes in and you see your name on it, well, what happens is a lot of times that all of the board members are named. And you could have 5 or 7 members on your board. Well, they're all named also. I've seen lawsuits that has named every board member ever that has served on the board. So what we're adding up are participants in a lawsuit. We have all of these board members. Of course, the association will be named in the lawsuit. So there's an entity. We have another individual, which most likely will be the manager. And then the other entity will be the management company.
Hey,
Well,
Andrew,
yes, sir.
before you get too far, you said a standalone policy. Can you explain a standalone policy as it relates
Sure.
to D&O versus some of the other policies that they may have?
Yeah, of course. Yeah, I apologize if I skipped that. So thank you, Ben. In regards to when I say standalone policy, it's an individual policy that is completely made for nonprofit corporations, specifically associations. The other option is that you may have an endorsement to your existing package policy. Well, it looks great because it says on your deck pages, oh, I've got directors and officers coverage. What is giveth on that page is taken away in the endorsements when you see all the exclusions. The number one, it's the second on this list, which is discrimination. Well, discrimination is excluded on every endorsed policy. So you need to make sure that you've got coverage for these lawsuits that come against your association. It will cost, the standalone policy could cost $1,000, $1,500, $2,000. It's all based on two ways. It's based on either the number of units in the association or based on the size of the budget, depending on which D&O standalone directors and officers policy you go with. So it can vary, but I will tell you, it'll be the most important coverage that you have, and you should not serve on any board of directors without it. When I say that there are companies that specifically work with associations, and I'm talking condominium associations, townhome associations, and single-family home associations. There are probably 5 or 6 that are really, they're great. USLI, awesome company, the #1 writer of nonprofits, but they are not designed directly for homeowners associations or condominium associations or townhome associations. They're the #1 writer in the country for the Heart Association or other types of nonprofits like that. It's a good policy. You can make it work, but for just $100 or maybe $200 more, you can get a policy that is designed specifically for your association. These standalone policies have unlimited defense. This is why when you have board members named individually, the only person that can remove a board member from a lawsuit is a judge. So counsel's got to be assigned. The counsel has to be paid. You've got to pay the counsel, the defense, the attorneys to remove the board member from the lawsuit. And that's just eating away your defense. When these standalone policies, they have unlimited defense that will protect the association. When you look at this pie chart, the #1 is it's a lawsuit against the association and the board of directors for your breach of fiduciary duty. As I started this presentation, this is one of your protections that you get from your Nonprofit Corporation Act in your state. When you get sued for breach of fiduciary duty, they're trying to breach your veil of your protection, and possibly your personal assets can be attached. So in that regard, you need a couple things. One, it's called final adjudication. I love using big words. Final adjudication, all that means is that you're going to be defended by this insurance until the judge swings the gavel. Once the judge swings the gavel, then whatever is decided, if you've been found that you've breached your fiduciary duty, well, then all bets are off. Then you may be defending yourself because you've been found that you're not putting the association's interests first. You're putting your own personal interests first. And so that is, I always say, you've got to wear 2 hats. You're a unit owner, so you have to have your interests there. But when you sit on the board of directors, you have to take off your unit owner hat and put on your board of directors hat. And that is when you put the association's interests first. That is the only way that you can protect yourself. It's easy to do. It's easy to put the association's interests first. The next one down, and I'm not going to go through all of them, but I'm going to talk about discrimination. Discrimination, as you look at the big piece of this pie chart, it's not the most common, but it's always the largest. It is the largest lawsuit against an association. Even on small claims, the average on a discrimination lawsuit is going to be $90,000. Without this insurance, you're going to be self-insuring, and you're going to have to be paying this out of your operating account, possibly your reserve account, possibly you're going to have to do a special assessment. So that's why, transferring this risk to an insurance company for this standalone policy is one of the best things you can do. The next one is violation of your covenants, conditions, and your restrictions. Well, you could be sued for not following you've got a duty for maintain, repair, and replace. It could be anything in the governing documents that you are not following. I'm going to skip defamation and harassment. I mean, that's on a rise also, that could be on Nextdoor, Facebook, where you're getting harassed, or you're, as a board member, you're harassing a unit owner, something like that. That has been ticking up a lot just because of the ease, and people are very strong behind a keyboard, and so they get themselves in trouble. One of the other things that's very common also is breach of contract. You just want defense that if you, let's say you have to break one of your contracts with, one of your vendors, but you've got a multi-year contract maybe with them, that this contractor may sue for breach of contract or non-fulfillment of the contract. Well, this insurance will defend for these allegations. But again, when the judge swings the gavel and makes a decision saying, okay, you canceled this contract a year early, they offered you a discount for doing a multi-year policy or a multi-year contract, you do owe this contractor the $6,000. That's not covered by insurance because you are contractually bound to do that. The defense is paid, but not what you're found legally binding on that contract. And so the last thing I'll say in regards to this is the best investment a board can do, is getting a standalone policy. Don't hesitate to do that. What ifs in regards to property insurance? So we're talking about a separate coverage. This is the physical property, and it could be a condominium building. It could be a townhome building with property coverage. It could be a clubhouse. On property policies, there are two exclusions that will be excluded unless you buy an endorsement to add it back in. And that is water intrusion around windows and doors. Well, the endorsement would be called wind-driven rain. Water that is just blown in around the windowsills. As I look to my right, I've got a set of windows. If water is blown around there, but there's no damage, there's no breakage of glass, it's just blown around, it's excluded because it's considered a maintenance issue. Water should not be blowing around the sills. Coastal communities, it is imperative for you to have wind-driven rain, and you should buy as much of the coverage as possible. Some policies come with lower amounts, like 100,000 or 250. You can buy separate policies that just cover wind-driven rain. It's usually up to about $1 million. You can buy more coverage than that. It just keeps getting pricey. But if you've got that much damage, there's usually causal damage also. The roof has been ripped off, or there's other damage that's allowed water in. But just know that wind-driven rain is an exclusion on every policy. It's got to be added back in by an endorsement. The second is very important, is your building has got a few years on it now. And from when it was built 10, 15, 20, 30, 40 or older years ago to today's building standards, the building codes have changed. And the increased cost. So here's our example is that my condominium and my whole condominium building burns. And the association now has to rebuild it. But this was from 40 years ago. Well, the increased cost of bringing it to today's standard, it's not in regards to the replacement cost, but it's the building code changes. So there's been fire sprinkler code changes. There has been, HVAC changes. There's been firewall changes, insulation changes. Well, the insurance will do replacement costs for today's standard, but when there's a building code cost increase, you've got to add, the endorsement is called ordinance or law coverage, and it's got three portions. It's section A is loss to undamaged portion. B is the increased cost of demolition, because if part of the building can be saved, it's more expensive to preserve the rest of the building. So there's an increased cost in that demolition and removal of the debris. And then the C, what I think is the most important part, is the increased cost of construction to bring it to today's standards. That is not included in policies, and you've got to add it in by endorsement. Mold. Hate it. Mold is a difficult situation. It all comes down to it's always when. When did the mold appear? If the mold is the very first thing that appears, well, mold just doesn't appear. Mold is over time that there may be an unseen water leak. Insurance companies have a right to exclude water leaks that have been going on for more than 14 days. The reason why is it's considered a maintenance issue then. So if mold appears on your ceiling, floor, corners of your room, well, and there's no other damage or there's no other visible water, well, there's most likely a slow water leak behind the walls. There's a good chance that the insurance company will not cover it because it would be considered a maintenance issue with 14 days, if the leak has been going on for more than 14 days. Insurance companies are sometimes flexible in regards to that. It's just as soon as you see mold, you need to report it as soon as possible or handle it. Find out where that water is coming from, because mold does not grow inside buildings. It should not ever. Well, the second thing in regards to mold is when. Well, let's say there's a damage, whether it's hot water tank bursts, HVAC drain pan overloads or overflows, water leaks from a supply line, a bathtub overflow, a washer and dryer supply line breaking, water is exposed, resulting damage. Well, now, since it was sudden and accidental, we have a covered loss. It seems like all of these water leaks always happen Friday night past 6 o'clock. And so it may be a few days until the restoration companies get off or get there, or it may be a few days until it even gets noticed. Well, that in the summer, it takes hours for the mold to start. Then the mold would be covered because it's part of the resulting damage from the water. So that is where mold would be covered. The extra cost that your restoration company wants to charge you, because they'll charge for the water remediation. They'll try for the drying. Then they're going to charge for, hey, we need to put down a special chemical that will stop mold from growing. Highly recommend it. It's really expensive, stupid expensive, but I do recommend it because in the future, mold may still be, there's mold everywhere in regards to the air, but people may claim that future breathing problems from this water leak, you just want to make sure that you've done everything you can to stop the mold in the future. But since this is a covered claim, those future allegations that they're getting sick from the mold, you'd have coverage there also. I put water 3 times. Why water 3 times? I'll tell you why I put water 3 times. It's absolutely the most common of all claims. This does more damage more often than anything else is water. And water is from damage to roofs, allowing rain and snow in. And I speak of snow because I have 3 inches of snow in my front yard right now. Water from all of the things I just mentioned where the mold could have come from. That is, all of the preventive maintenance items that every homeowner should be encouraged to be doing. And those are of course, change out your supply lines. If you see water, treat it like it's an emergency because insurance companies can exclude claims for long-term water. In a stacked unit, of course, when we have, in my high-rise condominiums, mid-rise condominiums, water does not stay put. You wish it would, but it doesn't. Water goes down and it always goes left and it always goes right. So with water, you've got to catch these things as soon as possible. One of the best preventive maintenance things you can do is identify water shutoffs in every unit, in every home, to make sure that the water damage that once it does start leaking, you stop it as soon as possible. Each of your covenants will dictate what is your insurance requirement on the insurance. Whenever there is damage caused by another unit and you have damage in your unit, you're going to be responsible for what you're required to do. When I say that is in condominiums, if you were built 1986 or newer, actually October 1st, 1986 or newer, you fall into the North Carolina's 47C, which is the Condominium Act. Condominiums will be insured inside and out. And the options are having improvements or betterments included or not included in the insurance. For townhomes with property, it's going to be 100% based on your governing documents on what the insurance requirement is. For condominiums prior to October 1st, 1986, your governing documents are going to dictate what the insurance requirements are, and you have to follow those. When you have damage in your unit caused by another, you're going to be responsible for what you're responsible for. So if you're responsible for improvements or betterments, you're going to be responsible for ensuring your improvements or betterments on your HO6. If your governing documents are not crystal clear in regards to the insurance requirement for the master association, if it's not crystal clear on how the deductible is handled on the master policy, and if there's not a requirement for the unit owners to carry an HO6 policy, I highly recommend you consider consulting with an attorney in regards to writing an amendment or at least getting an insurance opinion from an attorney. Your opinion, the attorney's opinion, will last until there's a counter attorney's opinion, because that can happen also. And then the most recent attorney's opinion would most likely stand in court. But I do highly recommend that you have your amendments, or excuse me, your governing documents reviewed. Make sure that they are crystal clear, because at time of claim, you don't want an adjuster to be determining what is covered and what is not covered. That is going to cause a gap between the unit owner's coverage and the master policy coverage. And we never, ever, ever want that. Your agent, somebody like me, should be writing a recommended unit owner's coverage letter. This letter, it should say things like, where can a get a certificate of insurance? Where is this referenced in the governing documents? And what coverage should I have to eliminate the gap between the master policy and my insurance requirements? And so I'm leading to one of the most important questions is every board should ask when you have property coverage. And the property coverage is in a condominium or a townhome with property or even a clubhouse. This is the most important question that you should be asking. I love this. I'm having fun with this, so bear with me. The first clue is the question is absolutely about property coverage. Second clue, who could be responsible if the answer to the question is wrong? Third, one option is an estimate. The other is done by an engineer. So what is the number one question everyone should ask? Where did the amount of property insurance come from? If you have a building and you've got X amount of property coverage, you better be able to show proof on how that number came from. Where did that number come from? Was it provided by your agent? Well, we're going to talk about that, which is the estimate. Did you let your agent just renew, or as a board of directors, did you just let your insurance renew? You have to look at where this property number came from for the replacement. The ramifications, again, comes back to do your fiduciary duty. The ramifications of this, the amount of property insurance, the board could be sued for failure to procure insurance. That's the name of the type of lawsuit it is. And this is where the board either didn't buy the correct coverage or didn't buy enough coverage. If there's a shortfall, the board and the association could be sued trying to prove that the board members breached their fiduciary duty. And this is the third time that I've talked about the breach of your fiduciary duty and what the ramifications are. With those, in getting back to those standalone policies, you want to make sure that you have failure to procure insurance on your D&O, so you will be defended for these allegations once the judge swings the gavel and finds either way that yes, you did breach your fiduciary duty or no, you did not. And the only way you do that is by covering your, I won't say you know what I meant. Everybody knows, covering your own behind, making sure you're crossing your T's and dotting your I's, and you're able to prove where that number came from each year. The other is that the shortfall in insurance could cause a special assessment. Somebody's got to pay for that shortfall of assessments. I always used to, in my other presentations, I would say, we've got a 5-story condominium and it's a $50 million building, but we only have 40 million of coverage. Well, we could just not build the 5th floor back. That's something that we could do. That never goes over very well on the 5th floor. They don't like that answer. So that 10 million's got to come from somewhere. The other is the shortfall could cause the coinsurance penalty. Well, coinsurance It has nothing to do with your health insurance. Coinsurance is a penalty put on by the insurance company that is making sure that these buildings are insured to value. It's basically so the insurance company gets its premium it deserves for its risk. And if you are so underinsured at time of claim, the coinsurance penalty could come into effect where there'll be a shortfall, but the insurance company won't pay the full amount. They will take 10, 20, or 30% off of the claim payment because you are underinsured.
Hey, Andrew,
Yes, sir.
can I ask a couple of questions?
Please.
So, one, I guess, can you review the recommended owner letter from the agent again and talk about what might be in that?
Sure. Always with and my marketing department came up with that one. And guess who's the marketing department? The unit owner's recommended coverage letter. It is an easy reference for every unit owner in the association to take this letter and then they go meet with their personal agent. It explains what is covered on the master policy, and it outlines exactly what each unit owner needs to cover. So it will cover the dwelling A property coverage. That is what covers your improvements or betterments or any interior of your unit. It also would respond to pay for the deductible in situations. Then you've got your own personal liability. If somebody got hurt in your unit and they are suing you or going after you for the damages that you caused them physically, you've got your liability coverage. You also need to insure your contents. Well, just imagine your contents are, you take your unit, you turn it upside down, and anything falls out would be considered a content, your personal property. So that would include your washer and dryer, your refrigerator. I would always include your dishwasher also. It most likely wouldn't fall out, but I would include it anyways. But you've also got to include your furniture, your clothes. When it comes to jewelry, artwork, firearms, silver or gold, coins, stamps, collections, anything, that needs to be itemized on your policies. What that means is they need to be written out exactly, what it's worth, and put on that insurance policy. You know, my ring isn't very fancy, but my wife's ring may be fancy. That needs to be scheduled on your policy so that if it's lost or stolen anywhere in the world, there's coverage for it. The two other things that you need to have is loss of use coverage. As a unit owner, the association does not owe you a duty to put you up in a hotel or a like living area. It is your own responsibility to cover it on an HO6 policy if you're in a condominium or in a townhome with property coverage. The loss of use, even on a single family home, if you've got a claim in your home, this loss of use will pay for the expenses of you to live somewhere else while your unit or home is being rebuilt. Because the association doesn't owe you a duty to that. And then the third, you would want loss assessment coverage. This is if there is like a shortfall in this example that I just used with, and you have to do a special assessment because of a shortfall, or if there is, unfortunately, with an amenity at an association, a park, pool, pond, or playground, terrible things happen. I insure just over 1,400 associations. I unfortunately have to deal with a serious or a death every year in pools. This could lead to large lawsuits that would exceed the association's insurance. That is another type of special assessment that would be put on by a judge, because you're all members and your deed is what makes you a member. that if there's a lawsuit that exceeds the insurance in place, the amount that exceeds the insurance in place will be divided equally by every member, and you will be required to pay it, and it will attach to your deed until it's paid.
Okay, next question. Can I ask a
Yep.
question, or do you have
Oh,
another thought on
please. No,
that?
go,
Okay.
no, go. Thank you.
So maybe kind of a three-part question, but the first is, for single family homes that just have a monument and not a structure, and maybe a condominium, where would you get the valuation and would you treat those the same?
Great question. And so when there is a building, and so we are going to get to you did the next question we'll answer. So I'll go to this question, right? Or the answer is, where did the amount of property insurance come from? So here's the answer to that question that you just asked. And I'll repeat the question is, where did the property amount come from? Whether it's a condominium, townhome with property, or where did the entrance sign replacement come from? The fence, the retaining walls, the mailbox kiosks, all of the different things that a single family will have. Okay. Well, in regards to a building, your insurance agent should be providing an industry standard CoreLogic report. I would call this an insured to value report, where it lists all of the square footage and the assumptions of the building material. And the last page will tell you the per square foot replacement cost. And that is an estimate, but it is an industry standard estimate that boards can lean on and should lean on.
So I'll say this, the next question is, should we trust our insurance agent if they provide us an estimate? So you're saying if they use this, you can trust your insurance agent.
I would say now remember, this is an estimate, and every insurance agent is going to say, hey, this is an estimate, that you as the board member are still going to sign the statement of values attesting that the values are correct. Every board that is on this call has signed a statement of values. You better at least have a CoreLogic report, because yes, I am not a builder, and many board members are not builders. But if you logically look at it and it's $800 per square foot, boy, that's really high. If it's $50 per square foot, that's really, really low. What you've got to do is use logic, your brain trust of the board members, and have your agent also ask them, what are similar associations being insured for? If there's still a question, this is where you should get the insurance appraisal done by an engineer. And we always recommend you use the engineer that did your reserve study, because it will be less expensive and they're the most familiar with it. But this insurance appraisal is the absolute most accurate. This is the only way to truly cover your decisions as a board, that if you get the number wrong, you truly have an engineer that has signed this document, and they will be the one that it's going to court.
And I'll just say, for single family homes where this really comes into play with monuments, if you have a car hit a monument and they somehow drive off, and you only have $20,000 worth of coverage, but it cost you $50,000 to rebuild, there would be a gap in that coverage. So.
That's correct. And so it's truly amazing how many vehicles hit entrance signs. It's like they have giant magnets, and I have multiple pictures of signs with cars sitting on top of them. But yes, where you get those numbers is, well, when the builder first built them, there's the number to start with. The second is to get a sign company out there to give you an estimate. Many times those signs are on walls. Your landscaper has experience in building brick walls, stone walls, whatever kind of walls they are. that your sign is sitting on, you can ask your landscaper for an estimate. You can ask your engineer that did your reserve study for the replacement cost. There are definitely ways to find out that information. Um, it does take work. You've got to document it every year, and you do need to lean on your reserve study or your contractors that work for you are the most familiar. The one that I get asked all the time is in regards to the pool and the pool deck. Well, look at insuring here's an example. Insuring the clubhouse is about 40 cents per thousand. Insuring concrete is about 3 cents per thousand. So it's much less expensive to insure the concrete, but damage still happens to it. Trees fall on it. I've had a car in a pool. I've had vandalisms destroy a pool. Who you ask is your pool contractor. Hey, I need you to give me an estimate on what you think that this pool will cost to replace it. Bam. Easy, shouldn't cost anything, but you've got to depend on your experts to help you with that.
So, Andrew, I know you have a number of slides to get through. We have a number of questions. So you tell me if you'd like questions or you'd like to hit, because there's some liability questions. I know we want to touch on cybersecurity. So,
Yep. What then give me 2 seconds. I'll go. I think I have um yep, last slide is this one. And so I just wanted to cover this real quick is what if it is not covered by insurance? Remember, maintenance is not a covered peril on any insurance. It's like if your car breaks down, there's no insurance for it. If your windows are leaking, you've got dry rot, you've just got to know that maintenance is not a covered peril. Roofs, you better be saving for your roof's replacement because insurance is not your savings account. You just need to make sure that you're setting money because you're running a business. You've got a long-term capital expenditure. Long-term water leaks are not covered. This happens a lot during hurricanes, tornadoes, is debris floating or blown onto your property. There is no coverage unless there's causal damage, like that property hit the entrance sign, wrecked the mailbox kiosks, or is done some physical damage to the buildings. Otherwise, debris that is just blown in or floats there or lands there after water recedes is not a covered peril. Trees falling are not covered unless they hit covered property. A tree falls, hits a condominium, the damage, the resulting damage to the condominium would be covered, and most likely the removal of that tree would be covered. But a tree that just falls and doesn't hit anything, there's no coverage. South Carolina, trees, every situation is different. In North Carolina, it's very different. A tree falls, crosses property lines, it changes ownership. The other thing is not covered is landscaping. Landscaping has very limited perils, so it is not usually insured. And so just keep that in mind that it's not worth insuring because there are limited perils that will cover it. Everybody's landscaping is different. Talk to your agent for your association and ask them about the landscaping because landscape lighting, that should be covered. Landscape walls should be covered. But the actual bushes, trees, flowers, I wouldn't. But each situation is different. Ta-da!
okay, you got there. I thought you had more slides.
I
So,
went through pretty quickly, so I'm sorry.
well, no problem. Question about clubs. So a community that is very club heavy or committee heavy. What is the responsibility of the board to name the clubs, include the clubs, and how are clubs insured under a association's policy?
Excellent question. I do a lot of 55 and over associations that are just riddled with clubs. I do, many, almost every association has clubs. So yes, great question. So in regards to clubs, the club has to be monitored by the association, and anything that the club is doing, the board should know about it. The club shouldn't be providing alcohol. Its BYOB is still very good, but alcohol provided by the clubs, like bourbon clubs, if it's has to be set up properly, I would consult an attorney and your insurance agent in regards to exactly how that bourbon club, wine club, all of those things are happening, because you do not want that liquor liability falling back on the association. I do not like bourbon clubs or wine tasting clubs for obvious reasons, but I'm not very fun. Um, but otherwise, the clubs have all of the liability and protection of the association. It's just like the committees and volunteers are covered for their activities, for their action or contributions to the association. And so when you have the architectural committee, they would have all of the rights to the policy. The bridge club, if they are using the clubhouse, they have all of the coverage from the insurance. It is when the clubs are doing things that are questionable, that is where they need to cross their T's, dot their I. The most fun is always the, oh, help me, Ben, it's not the entertainment. It could be the entertainment committee. They always want to have a Christmas party.
The
And
social committee.
social committee, that is it. Thank you, sir. That is the club that wants to have a Christmas party. I'm all for Christmas party or holiday parties, excuse me. And they want to have a holiday party. And they want the association to provide alcohol. Well, now you've got to have the protections in place in regards to having that, because liquor liability, you're an association. You're not a social, you're not set up as a social entity, but clubs are very much part of every association. You need to have caterers, or you transfer that risk, or you carry liquor liability and you hire bartenders.
So to summarize, if there is a club in place and they're doing normal activities, they will be covered and you don't need to name them. If they are
That's correct.
doing activities outside the norm, let's say handling money, do they need to adjust their financial or fiduciary policy that they have?
Well, then that's, clubs. Now you've got to make sure that, are they sanctioned by the association? If they are, then that club's monies should be handled by people that are involved with the board. Handling money, and this is where, having, this is, I'm going to use this as a segue to the crime and fidelity. Every board and association needs to protect their own interests. Yes, you've got an awesome professional management company. They have taken away 95, 96, 97% of the risk when it comes to cyber claims. We'll talk about that. And crime and fidelity. That means the embezzlement from your money. 20 years ago, every manager had filing drawers and had checks in it where they actually were receiving money. They're mailing the checks. Well, now you've got an awesome management company that has checks and balances. They have a management system that handles lock boxes. The check payments are coming directly from the bank. The payments are going directly to the bank. There are checks and balances where the manager does not have full rights to having access to those accounts. They don't have access where they can walk into the bank anymore and take money. There's an accounting department. Every invoice has checks and balances. But remember, I just said that your management company takes away majority of the risk. There's still the risk on the board side. if the board member, spouse, or third party, let's say a cleaning person, for a lack of a better term, any of those parties steal money, embezzle money, that is not the fault of the management company or the banking system. You've got a criminal on your board. They don't allow background checks to board members. And so you don't know who's getting on the board. Hopefully it's a great neighbor but it's always as if there's a downturn in the economy, these types of crimes pick up. The crime infidelity is what protects the operating reserve account from embezzlement, check fraud, wire fraud, and other financial crimes.
Okay. Question of the year. What percentage increase do you anticipate for 2025, 2026?
Great question. We have actually seen on our high insured values a much smaller increase than we have seen in previous years. So if you've got an insured to value of 20 million or more, we are seeing, and this is with nothing out of the ordinary. When I say nothing out of the ordinary, you're not a 50-year-old association. You haven't had 10 water claims, but somebody that's got a, reasonably clean loss runs, they're 30 years or 30-year-old building or younger, we're seeing 5% or lower increases. It has truly leveled off. So what do I see by the end of the year? I see that increasing again, but from January 1st to today, our renewals have been very, very competitive. We're seeing positive things. No matter what the timing of renewals, a standard market is one that is registered to do business in North Carolina as opposed to an excess market. Excess market is that they can write business in North Carolina, but they're not regulated by North Carolina. They can charge rates, whatever they want. This is for associations that have had claims, or they're older association, or they're coastal. So there's a standard market and an excess market. Timeliness of receiving claims, a standard market, the earliest you will ever see a renewal is going to be 30 days. 10 years ago, you used to get them 60, 90 days. Well, insurance companies are not releasing them until about 30 days. Got to give your agent a couple days to review it, but you should be getting your renewal at least, 25 to 20 days prior. Well, excess markets are different. Excess markets, there's only limited capacity. When I say limited capacity, insurance companies only have so much insurance that they can offer. So what they have to do is they're holding on to that renewal quote 10 days, a week prior to the renewal, because they have to hang on to that because they don't know what their other quotes have done. So they have only limited capacity. Then they're going to start releasing that. And those prices change, they fluctuate more. So they hold on to those pricings until late. And that's not going to change because we are still in a hard market. The hard market means it's difficult to get insurance. Insurance companies not lining up to insure these risks. So it will stay this way. A standard market, 30 days would be great. Standard or excess market, excuse me. If you get it 10 days prior, that is reasonable. That's probably, and it's out of the agent's hands in regards to that.
Well, I hope you're right when it comes to 5% insurance increases. I don't know if I'm going to hold my breath on that one, but
Well,
Come
that's
budget time.
yeah, yeah, that's right. And one of the fun things is that, we're seeing that we have a couple markets that are exclusive to myself and my agency that we are seeing this, and
Okay.
we're having huge success with it. Your last question was regards to cyber, real quick. Every management company has a cyber policy and cyber coverage. That is where majority of the risk is on the management side. But boards need to protect themselves because if something happens with a board member, let's say a board member has their laptop and they've got an Excel spreadsheet, and on that Excel spreadsheet lists the unit owner's name, their phone number, address, email, and all of the normal information that you would have as a board member. North Carolina's definition of a cyber breach is two pieces of information are released to an illegal or somebody that is using it for opening credit cards, taking out loans, things like that. The cyber liability is what pays to make that person whole, pays for the credit monitoring, and then pays for, because it's very bad press and to any expense to bring, you know, uh, to get out of the bad press of the cyber. That is all the three things that are paid for on the cyber is pays what the damages were to that person. If multiple people are affected, that their information is stolen, credit monitoring is paid for. And so and that is, remember, it is covering the association's interests and those board of directors if something happens on their side. The management company has their protections. So you've always got to protect this nonprofit corporation. You're the board of directors. This is where A, you always protect yourself. B, you protect your assets with crime and fidelity. C, cyber liability is something that associations should look into.
And we have seen a number of board members and vendors get their email hacked, and
Oh,
it is definitely causing some additional risk when it
yep.
comes to
And
cyber
it's
theft.
and it's the social engineering is the other thing, is that when people are tricked, that is where you receive an email from me. It says Andrew Bateman, but when you hover over it, it is a not my email. So verifying emails by calling the person is highly recommended because the tricking of social engineering is a huge growing problem also. The crime and fidelity does offer coverage for that.
Okay, we do have a number of questions lingering. So I know it is past 5:30. So if you do need to drop off, you can, but we will continue to answer a few of the questions. So next question is, you had commented on the USLI policy. Are you not recommending that one, or are you saying that it's a good one to keep?
There are better out there for a couple $100 more. If I was on that board of directors, I would look to get a better policy.
Okay. Is it a conflict to file an insurance claim against a contractor doing association work on behalf of the unit owner?
Say that question again. I
So
want to make
is it a conflict to file an insurance claim against a contractor doing association work on behalf of a unit owner? So you're filing, I guess if there's an issue in a unit owner's condo, but they're doing work for the association, you file the claim on behalf of that unit owner for against the contractor doing the work.
well,
And you're essentially
no,
filing a claim,
yeah.
as the association.
Well, the biggest thing is that this is where every association, if they're hiring a contract, they should have a written contract. If it's a contractor that they use multiple times throughout the year, one contract, 1 year. But let's say your fire sprinkler suppression company. I just had a it's a huge claim where the fire sprinkler contractor did the damage to what they were doing is they were connecting their lines together. They pressurized it. The guy was on the first floor. This was in the third floor, but it wasn't connected properly. Clearly, the contractor caused all of this problem. Yes, that contractor should be the one that is going to be responsible for this. What can happen is two, you can go out directly after the contractor, but a lot of times the association places the claim, pays the claim, and then subrogates after that contractor. But the responsible party should definitely be paying at the end.
Okay, this next question, I think you've commented on, and it may be more of an attorney question, but we currently have no bylaws on renew to CAMS. What is our insurance protection besides our current property insurance?
Well, if you don't have bylaws, well, there as yes, of course, and it's an attorney question, but I'm only doing it as an insurance person. The hierarchy of um, documents is always the articles of incorporation. Then it goes to
CCNRs.
yep, and then it goes bylaws are below that, and then rules and regulations are below that. And so if you don't have bylaws, their job is to help you organize and how to run the association, electing board members and things like that. If you've got covenants, that is, the driving force behind what your requirement is. There, I don't see any problem with not having bylaws. You're probably an older association. You may want to absolutely reach out to an attorney and have them create bylaws for you. Um, it just helps,
So as long as
helps
you're
the association.
incorporated, right? As long as
Yeah,
you're incorporated, you're protected by the Nonprofit Corporate Act.
that
And
is
so
correct.
there would,
I
and
would
then
buy that.
yeah, so there
Yeah.
would be some protections in place, but yeah, that may be a offline discussion to have. Um,
Yep.
okay, next question. Condo association has an uninsured marina, which is known by the owners and stressed in the annual meeting and agreed upon by all owners. Documents say the board is required to keep adequate insurance on the property, but does not specifically exclude the marina. How do we protect the board members from the charges we are underinsured by not insuring the marina?
Well, I would first off, you should consult an attorney in regards to that because you may be just breaching your fiduciary duty for not following the governing documents. Second is I would have a standalone directors and officers policy. If you know this and are wantonly or purposefully not insuring the docs, you better have quotes from an insurance person that has provided actual dollars and cost to it, and you've made a business decision not to do it and have an attorney back this up saying, because the term reasonable could be brought in, you want to make sure that, consult an attorney, make sure that the cost is deemed unreasonable. And that is the reason why you're not insuring the docs when you're required to carry them. You just better have an answer to that question.
Yeah.
But it should have standalone directors and officers for that also.
Yeah, that would get a little, sounds interesting there. So can you explain the liability and or fiduciary responsibility if a board recommends a fee increase or special assessment, but it does not pass by the unit owners?
Well, that's the best thing. Or not, I mean, that is, you've done the steps, you brought it to the unit owners and they turned it down. You've done all that you can do. There isn't anything more that you can do unless, again, consult with the attorney, see if in the governing documents that you can increase the assessments without homeowner approval. And then you need to do it because you're running a business. You have to have money to continue. This is what led to the collapse of Champlain Towers, is because for 5 years, they put out a special assessment and it was turned down by all of the unit owners to do the structural improvements that were needed. Well, they delayed, delayed, and delayed. And that's what happened.
Yeah. So I'd say as a board member, you're doing your fiduciary duty to continue to propose it. The association may still have some responsibility, but maybe as an individual board member, you would not.
Right. You've done all you can do and you're following the steps. Yep.
So keep pushing it if it's needed, because that will continue to help limit your exposure. Can you offer an example of discrimination issue that could cause someone to sue the board?
Sure. Yeah. Unfortunately. Discrimination can come in a couple ways. It, of course, is all of the protected classes. FHA HUD has a very easy website that any unit owner can log on to. The charges is $25 and they're asked 5 questions: who, what, where, when, and why. A easy example, it's not the most common, but an easy example is a unit owner gets a violation letter. What do? They go out to the front door and they look around the neighborhood and say, well, those people have a commercial truck in their front yard. They've got an RV, they've got a boat, their fence, their lawn, everything out. And you emailed this or sent me this violation because you're singling me out because of any of the protected classes. The other thing is where the associations can get sued is if they have improper signage or rules that discriminate against any of the protected classes, against, the signage not allowing, familiar status or just different things like that. Discrimination, definitely. One of the biggest claims we ever had was due to a sprinkler head was outside the confines or the boundaries of this person's yard. The sprinkler head was 10 feet into the common area. They received a violation letter to move that irrigation head, and their defense was that you're singling me out because of my race. And so they sued the board as a countersuit in regards to claiming discrimination.
And we've seen some discrimination issues, FHA related discrimination issues, where it was as simple as having Adult Swim in a pool contract, and someone sued due to the pool contract that referenced age discrimination issues. So
Right.
it can come in all different sizes, shapes.
Yep.
But okay, I am an active realtor and serve on my board. I keep board activities and any business outreach in the association separate. Any concerns or additional liability I should consider?
Well, I'm married to a realtor also, and I told her not to get on a board, and she did anyways. She lasted a year and a half. I never said I told you so, but I no, nothing to do with your license or anything that you should be worried about. You just make sure that you are changing your hat. You may have to do it even a little bit more so people don't think that you're doing things for your own interests. You just need to make sure that you're switching hats because you're a homeowner, but you take it off. You're a realtor, you have a different hat. But when you're on the board, you're making sure that you're only putting the association's interests first. And then no, you shouldn't have any problems. Good question.
And I'll say maybe the last question, if we are concerned about having enough coverage for our board members, what should we do?
Reach out to there's a number of specialists in this state that specialize working with associations. You should reach out to them for a review. There's no cost to get your insurance reviewed. We do reviews every day and we make recommendations from it, but we always start with a review. You should always have a review to know what you've got and let a professional give you recommendations and give you options because you have to be able to make a business decision. Our job as insurance agents is, well, some just want to sell you policies. Some want to help you with information to help you make a business decision because your association, just because you're presented insurance doesn't mean you have to buy it, but you do need to have an answer to why you didn't buy it. Maybe it's because you didn't have the risk. Maybe it was too expensive, but you better been shown all of the insurances. You let your agent show it to you. There's no cost for us to show you quotes. It, it is the best way to help you guys make a business decision is to look at your options with insurance.
So, well, that is in the end. I want to make one comment for those of you that are still with us, and just to let you know that hopefully everyone here has already signed up for the Corporate Transparency Act and listed their beneficial owner information. We have been watching this ping pong match for the last many, many months between the Supreme Court, the federal government, and others that have filed suit. Just the other day, I think it was yesterday, they did say that everything that had been discussed regarding the Corporate Transparency Act is back in play. So if you haven't registered, we need to make sure that you're registered as a beneficial owner. They did say that associations aren't the primary target. So there's probably some time, but it is part of the federal law that is in place regarding the Corporate Transparency Act. So we do have a lot of information out about the Corporate Transparency Act. We've done 2 different webinars on the Corporate Transparency Act, and on the CAMS portal under the board member resources section, we have information about the Corporate Transparency Act. So unfortunately, we're going to have to continue to talk about this. It's not going anywhere, but we do have solutions to help sign up. But it's free if you go and sign up yourself. There is a fee if you use some of the CAMS software to do it. So with that, my last comment is thank you. Thank you for joining us. Thank you, Andrew, for helping guide us through insurance issues. Yeah, a reminder, it is recorded. You can find it on the camsmgt.com website under our board member resources page. So thank you again and good night.